Bob Miller, what is the symbolism if the Lehman Barclays Bloomberg Total Return Aggregate Index breaks down to new lower price and higher yield? How do you redefine the bear market if we get that technical breakdown?
Well, good morning, Tom. I hope all of you are well. It's good to be with you. Look, we think that yields are now reasonable. So yes, they can, prices can go down and yields can go higher from here, but we're in the range of reasonable. Fixed income offers, some reasonably attractive opportunities today after, for the first time since 2018, and certainly after the period of no opportunity 2 years ago and a year ago. So you can build a high quality portfolio that has a 4 to 5% yield, including treasuries, high quality credit, even high quality, add some high quality high yield in the 8.5 to 9% range. You can build a pretty attractive portfolio for the first time in years, and specifically in U.S. fixed income. And we think that that's something that investors ought to be thinking about for the next year. No doubt things have been ugly this year. And there's no near-term relief in sight, but valuations matter, and these valuations look reasonable to us.
They look reasonable compared perhaps to a year ago. They won't necessarily look as reasonable in a year if 10-year Treasury yields are 5%, where some people are suggesting they could be. Are you in the camp that says that we have seen peak yields on 10-year, or that we're close to it, even as we do see them start to climb and push up against and test some of the highs that we've seen of the cycle?
Yeah, at least I don't know if we've seen the peak, but I think we're close. Because we're in the camp that inflation is going to decelerate, growth is going to decelerate. I think it's really important to keep in mind the magnitude of the financial conditions tightening that the Fed has engineered in just 6 months' time. They're going to raise rates by another 75, most likely in less than 2 weeks' time, pushing the funds rate to 3. That's in a 6-month period of time, 300 basis points off zero, 600 basis points annualized, right? This is not an insignificant move. It's a meaningful move, and it takes time, right? The famous long and variable lags. It takes time for policy adjustments, easing and tightening, to work their way through all of the cracks in the economy. It's coming. I think it'll be very unlikely that we look up in 3 to 6 months' time and growth and inflation haven't slowed by a sufficient amount that the Fed is probably able to pause with rates around 4% and just sit there for a while. So in order to get a 5% 10-year on a 1-year horizon, wow, a lot of things have to go wrong, right? Maybe it could be, but a lot of things already have gone wrong, and I think it's a little dangerous to extrapolate the last 9 months into the next 9 months without considering what's happening to financial conditions in the U.S. economy. They are tighter.
Yeah, although you do still see the consumer having some strength, particularly with oil prices, or at least gasoline prices, coming down a bit. Have we fully taken into account the fact that Europe has also moved away from negative yielding regime with the biggest ever rate hike at the ECB meeting last week, and is poised to do more, that there is a cohesive and global synchronized rate hiking cycle that we really haven't seen in modern history?
Yeah, it's a great point, and I would argue that adds to the reality of financial conditions tightening in a lot of different places, not just the United States, and that will ultimately have a delayed but likely a real impact on growth and inflation over the next year or two. Keep in mind, there's one central bank that isn't participating, that we think will likely be forced to by their own inflation dynamics in Japan sometime over the next 6 to 9 months. We wouldn't be at all surprised to see the yield curve control program that's been in place for some time, at a minimum, adjusted slightly, if not adjusted by a reasonable amount.
Hey, Bob, we've got to pick up on that. Final question. What does that mean? And how would the rest of the global bond market respond to a move like that?
Yeah, so Jonathan, great question. That's where, like, if you asked me what's the scenario where the question Lisa mentioned about a 5% Treasury yield, what's the scenario where that's a reality? It's either just unbelievably persistently high inflation that the Fed cannot get under control, so the front end is likely at 5, if not higher, or it's some resumption of global term premium by the ECB not only turning off QE, but perhaps even pursuing some balance sheet runoff, and importantly, the Bank of Japan abandoning yield curve control. I think all of that, each one of those is individually pretty low odds. But that is the scenario where if you want to get really bearish on bonds, I think you've got to have something like that in mind.